Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, 20th January 2023, and joining Lee to pose some questions on the financial market themes for the week ahead is Reza Nasehi, Vice President of the Japanese Client Sales Group for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Good afternoon, Lee.
Hi, Reza.
So the big focus this week was indeed anticipation that we might have seen some long-awaited change to Bank of Japan policy on the 18th, albeit our core scenario was of move only occurring later this year. Dollar yen dropped 5% following the change to YCC in December. However, the Bank of Japan did disappoint by maintaining its monetary policy setting, which saw dollar yen hit over the 131 handle on Wednesday. What did you make of the market reaction to the BoJ outcome, Lee?
Yeah, well, I guess given the outcome was that they decided to leave yield curve control policy settings unchanged. Like you say, that was a disappointment to the market. We had seen speculation building up ahead of this week's meeting in anticipation of a further policy shift from the BoJ. See, the big surprise came back in December when they raised the yield curve control target for the 10-year yield by 25 basis points up to 0.5%. And that just really encouraged speculation that they could shift policy again at this week's meeting. But as we say, that never happened. So there was some disappointment there. And that obviously fed through into the FX market, with the yen initially weakening quite sharply by over 2% against most of the major currencies. But I think what we've seen really since then is that the yen has quickly bounced back and reversed most, if not all, of those initial losses, with dollar yen dropping back towards kind of pre-announcement levels around 128.50, which tells you that, yes, market was disappointed that they didn't change yield curve control policy settings this week. But as we expect going forward, the anticipation will very much remain in place that this seen still is more of a matter of time before yield curve control needs to be adjusted again. The BoJ themselves said this week that they just wanted more time to assess the market impact from their policy change in December. And if the functioning in the JJB market doesn't improve going forward, like the BoJ would like to see, that will keep pressure on the BoJ to adjust yield curve control settings further. And then on top of that as well, we also have the upcoming change in leadership of the governor at the BoJ, with Kuroda's term coming to an end in early April. He only has one more policy meeting, which he's in charge of on the 10th of March. And the speculation over potential shift in policy from the BoJ under new leadership, that's likely to remain elevated as well, at least until we get greater clarity on who the government is going to put forward as their preferred candidate to replace Governor Kuroda. So all in all, a bit of a short-term setback for the yen this week, but it doesn't change our overall outlook, which is still bullish, and we expect the yen to strengthen further from here. And that reflects as well our view that we think the yen at these levels still remains deeply undervalued against the dollar and other major currencies, and that the balance of risks from a fundamental point is also pointing towards further yen upside going forward.
Given the core annual inflation rate in Japan rose to 4% in December, which is the highest level since December 1981 and the 9th straight month above the BoJ's target 2% level, and furthermore, given, as you mentioned, the next meeting will be Governor Kuroda's last, this will obviously keep speculation fueled of a policy change. What kind of change do you anticipate, Lee, and when?
Yeah, it's a good question. Like I said before, we expect that speculation over a further shift in yield curve control settings to remain very much in play in the coming months, which will keep upward pressure on the yen and also on JGB yields. So that we could certainly see the BoJ coming under continued pressure to purchase JGBs in the market to support the yield curve control target level. In terms of our own expectations, our economists over in Tokyo are of the view that we will see a further shift in yield curve control settings in the second quarter after Governor Kuroda has left the BoJ and the new leadership is in charge. We do think there's an increasing likelihood that the BoJ may have to fully drop yield curve control. But when we do expect them to drop yield curve control, we still feel that they will emphasize that this is not part of a process to start raising rates anytime soon. So reiterating that the inflation outlook is still not yet justifying a significant tightening of monetary policy. So thereby emphasizing that they remain kind of committed to maintaining negative rates through the rest of this year. So that could be certainly a dovish angle from the BoJ if they do indeed still drop the yield curve control.
Lee, there's been a more positive mood in financial markets since the start of the year, and this has certainly been evident this week. We've seen equity markets boosted, bond yields sliding, further hope of easing inflationary pressures, which was certainly corroborated on Wednesday when UK inflation was released. Of course, there remains anticipation that central banks will soon call a halt to present rate hike cycles, etc. And in terms of kind of notable releases this week, we saw UK CPI released, as mentioned, at 10.5% in line with expectation and lower than the previous month of 10.7%. UK unemployment rate was unchanged at 3.7% in November, and pay growth accelerated again. UK retail sales fell by 1% in December. Similarly, US retail sales and industrial production fell sharply, albeit partly due to bad weather effects, and the expectation component of the German ZEW survey rose to an 11-month high in Jan. What are you watching out for the week ahead, Lee?
Yeah, the one which we would kind of highlight as one event to watch for would be the Bank of Canada's upcoming policy meeting. Obviously, during this global tightening cycle, the Bank of Canada has been kind of leading the way in terms of hiking rates aggressively ahead of other major central banks. And we do believe, like the market, that the Bank of Canada is likely to be one of the first, if not the first, G10 central bank to pause their hiking cycle. So this week could be important. We're looking for another 25 basis point hike in the week ahead. And the way the market's priced at this point is that the market is skeptical over whether the Bank of Canada will need to raise rates even further beyond that point. So the market is certainly looking for a clear signal next week that the Bank of Canada is thinking seriously about pausing their hiking cycle. And if we were obviously to get that message that they are at the end of the tightening cycle for now, I think that could have an important impact on FX markets and financial markets more broadly, given that, like I said, Bank of Canada has been kind of leading the way. So if they were to signal a pause is coming, that I think would initially be seen as obviously negative for the Canadian dollar. Would lead to a further weakening of the Canadian dollar against other G10 currencies. But on a kind of wider basis as well, that could spill over into other markets. So the idea that the Fed is also quite closely following the Bank of Canada, it could certainly reinforce expectations that the Fed's also getting close to the end of their own hiking cycle as well. And if those expectations were to be reinforced by that Bank of Canada pause signal, that could as well reinforce the selling pressure that we've seen in the dollar at the start of this year and lead to some further downward pressure on US yields. Admittedly, of course, the US rate cycle doesn't necessarily completely follow the Canadian rate cycle, but that's certainly the market could certainly look at it to be very kind of close and start to reinforce those expectations that Fed policy as well is getting close to a pause.
As always, extremely informatively. Thank you very much.
Thank you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research Team.